I always make sure that I'm not going against the city. I don't want to get into a big legal fight with the city over what I can and can't do. I want things to be smooth and amicable. So I'll go in and I'll just straight up ask, I'll say, I got this piece of land. This is my business plan and what I want to do on that. Is that something that y'all would like to see?
If you're paying too much in taxes and you want to recession-proof your investment portfolio while also avoiding those common pitfalls that many investors and syndicators fall into, you should attend Think Multifamily's annual Fire Summit Conference, November 11th and 12th. You can save $100 by using promo code Whitney100 when you go to thinkmultifamily.com/fire. Again, that's promo code Whitney100 to save $100. This is your daily real estate syndication show. I am your host, Whitney Sewell. We are back again today with our guest, Andrew Brewer. He's got many years and lots of experience in ground up development. We're going to dive into different aspects of this asset class, whether you are active or passive. I know you're going to learn a lot today. Don't forget to like and subscribe to the show or leave a rating, written review. We would be forever grateful. Andrew, welcome back to the show. Appreciate the listeners being with us again today as well. I hope you will go back and listen to the last couple of segments with Andrew as well, and just how he got into the development space and also diving into what is ground up, and even dived into more about entitlements and that process, which I think is so helpful, whether you're active or passive. You need to know about some of those things before you get started, whether, like I said, whether you're active or passive. But we're going to dive even more into things today that I feel like, again, whether you're active or passive, you need to be aware of. Andrew, welcome again. Let's dive in, Andrew, to some of the risks. I mean, obviously commercial real estate, but obviously ground up development, or how we mitigate the risk as much as possible, right? That's what investors want to know, and that's what us as sponsors want to know. No matter what type of investment structure you have, we need to know how to do that the best to mitigate those risks. So why don't we dive into some of the risks that you're familiar with, and maybe some that that a lot of people are not familiar with, that would help us to better understand and how to move forward in investing, active or passive.
Yeah, definitely. I will say that the number one risk that you're going to encounter in any kind of development is the government and your neighbors. Basically, other people are your biggest risk. Not all development projects require approval from neighbors, but some do. So if you're doing a project that's going to require you to go to, city council and do a vote there, where you've got city council members that represent, all your neighbors, those neighbors may call their city council person who probably lives in the same neighborhood and is probably friends with them, and tell them, well, we don't want this development there. And so, vote against it, and that can blow your deal up. You could do everything right. The deal could be awesome, and that could just blow up. That is one of the massive risks. Typically, you're dealing with that less when you're dealing with, commercial properties and office buildings and stuff like that, because generally you're developing in, not really like someone's neighborhood. Really, you kind of hit the city council votes when you're dealing with, residential stuff. Maybe, you're trying to subdivide, 10 acres or something that's adjoining, a neighborhood, into some more houses, or, God forbid, you're trying to put, an apartment building in the middle of a very wealthy neighborhood or something like that. So that's a huge risk. And then also just the government, whatever the governing municipality is, they might say no. And, for me, the best way I found to mitigate that is simply go talk to them and see what their opinion is. I found that if you go down to the city, talk to the city manager, the city planner, fire marshal, city utility director, all of those people that are going to be making the decisions about whether your project goes through or not, go talk to them, see who they are as people, see what they want to see, what their vision for the city is, because just like any other politician, while somebody may have voted them into office, and they may have said they're going to do a certain thing, ultimately they're going to try to shape the city how they want it to be, whether or not that is what everybody in the city wants or not. I mean, maybe it is, maybe what they're doing is what the city wants, or maybe it's not, but they'll just go against that if they want. Understanding the city's vision for the future with the current, staff in place is another big thing. You can find a lot of stuff like that by looking at a city's future land use plan, which is usually available just online on the city website. And that'll give you an idea for, the city's growth, how they want the city to develop over time. If you're dealing with a smaller city that's got, a few thousand people or, 20 or 30,000 people or something, generally on the future land use plan, they'll be showing, like, hey, this area over here, we want to be like, commercial hub where we're going to put like commercial buildings. This area over here, we want to be, high density residential. This area, we want to be a transition zone between residential and commercial. We want the city center to be over here. We want, this to be farmland. We want industrial over here. And they'll kind of outline that. And that'll give you a really good idea of, what they want to see. So as a developer, if you, get a lead on some piece of land and you think like, oh, this would be great to put up an office building, but you go and look at the future land use plan and it says that, well, that area, they want it to be heavy industrial, or they want that to be, apartment buildings. You might think, oh, well, that's going to be a harder project to get through now because the city's not saying that they want this here. Whereas if you say like, oh, I want to put an apartment building here, and you look on the land use plan, it says, we want high density residential, rentals. You say, oh, okay, perfect. This will probably be a little bit easier. You go talk to the city about that. And I think as long as you are conforming to the city's plan that they already have, that lessens the risk a whole lot. So whenever I'm doing a deal, I go to the city, I talk to people. Developing relationships with the city is great also, but ultimately probably isn't going to change the future land use plan just by like knowing someone. So I always make sure that I'm not going against the city. I don't want to get into like, a big legal fight with the city over what I can and can't do. I want things to be smooth and amicable. So I'll go in and I'll just straight up ask them, I'll say, I got this piece of land. This is my business plan and what I want to do on that. Is that something that, y'all would like to see, or that would,
would you own the land then though? Or would you maybe just have it under contract, or would you even have it under contract yet? What's that?
I would just have it under contract.
Okay. And your contract is dependent upon you getting the entitlements completed and some of those things. Is that accurate?
No, with the market the way it is, like sellers don't go for that.
Yeah.
Like they're not going to go into a contract where you're going to say like, I'm only going to perform if X, Y, and Z. And this is why I get a long feasibility period, because it allows me to go in and do everything I need to do and still back out. But I also know that at the end of my feasibility period, my earnest money is going hard. So I have to find out my answers in that period of time.
How long is that typically?
That can be anywhere from 3 to 6 months.
Okay.
Or even longer, maybe, depending. I don't think I've had a project that had longer than 6 months on it. But yeah, I go to the city, and if I get any inclination that the city is not going to be on board with the project, I'll just drop it then and there and go find another project. Like I don't need to go fight with the city or try to force a deal through.
Yeah.
That's just too much risk.
Yeah.
I say no way. I want to go find projects where the city is excited about the project. They want to see it. They say, yeah, this is a great idea. We really need this product type right here, right now. Like, we're going to help you out on that. Like, that's what I want to hear. If I don't have that enthusiastic yes, it's too much risk for me.
Yeah. What about, any other strategies just to mitigate the risk, for your investors as you are, pursuing ground up or just to ensure they're protected? Anything else that maybe we haven't talked about?
I follow my, my list of, kind of internal questions that I have. I'm always, I run a series of, third-party reports, environmental reports, geotechnical reports, if there are specialty reports that I have to run, waters of the U.S., delineation reports, wetland reports, endangered species reports, anything like that I have to run, I'll do that so that I have all of the answers. That really is the only way that I've found to mitigate risk. Unfortunately, development is an expensive game to play. It's not cheap. It's not like, flipping a house or, some of these deals where you see where it's like, oh, I did it with, no money down out of pocket by just, negotiating a seller carryback thing. That doesn't work the same way in development if you're doing it right, because you do have to go out, you have to spend money on third-party reports. You do have to, spend money on, an engineer if you don't have one on your staff to figure out some of these questions, and that could be anywhere from, $5,000 to over 100,000, and I've done deals. I think the lowest deal I had was about 15 grand in DD, and I've had deals that were over 100,000. And, that's risk that I take on. That's just what it is. Like, I don't feel comfortable, half-assing the deal and saying like, yeah, it's going to be fine. Like, you don't know it's going to be fine. If you're dealing with other people's money or you're expecting to get other people's money to fund the deal, like, you got to be sure. Like, I treat other people's money the way I would want other people to treat my money, which is, with the highest degree of respect. And, I do my research beforehand. And if that means that I end up losing money, I would rather lose my own money up front, because I know that I can go out and find another deal that is going to work well, and my gains will
for sure
more than make up for the deals that I have to drop. That's just, my opinion. I know people that don't always do all that research, but I think that is
of course
necessary.
Which leads to more questions an investor should ask, right?
Exactly.
But even on that note, what about, structuring these deals? I know, especially developing, be willing to be flexible in the way deals are structured, or there's so many different ways and types of, ways to structure a deal. But maybe you could elaborate on some of the structures you've used, or ways that those have maybe helped mitigate risk, or maybe even types of structures that may not help mitigate risk, but at least the ones that you like to use or have found to be successful.
Yeah, definitely. Like you said, there are, an endless number of ways to structure deals. And, really it's about what everyone can agree to. Sometimes that's not always what I would think people would agree to. In my personal opinion, the best deal structure, when you're dealing with a passive and when you're dealing with a large number or just a few passive investors, the best deal structure is one where the sponsors and the investors' goals are aligned, and where the LPs, or limited partners capital is protected, which is really easy to say, but not everybody does that. Everybody always says, "Oh, I've structured the deal to protect my LP's capital." That's not always true. One of the main things that I do there is I try to tie all of my compensation in the deal to performance metrics. So a lot of the deals I do, I won't take any fees, or my fees will be very, very minimal. So I'm typically not charging a development fee. I'm not really charging an acquisition fee. I'm not charging, management fees throughout the course of the deal. I'll structure it so that all of my compensation is in the form of a profit split on the back end. Typically, I'll give my investors a preferred return and a full return of their capital before that profit split. And I'm doing that because, I'm trying to convey to my investor, like, look, you're trusting me with your money and you have a good reason to, so much so that I'm willing to, do this work for free up until a certain point, because I'm confident in my ability to execute the deal. I've done my research. I know that I have a good deal. And if this deal doesn't work out, I want to make sure that you're not losing, because at the end of the day, you're a passive investor. You don't know what I know. I could hide a bunch of stuff in the deal and you would never know about it. I'm not going to do that. I'm going to put my money where my mouth is. You're going to get your preferred return and all of your money back before I see a dime. I try to do that because I think a lot of deals where sponsors are collecting a lot of fees, those fees are coming before the LPs are getting their money back. So I'm sure a lot of people that are listening have seen value add deals where the sponsor will take an acquisition fee at closing, and they'll take an asset management fee. Maybe they're the property manager also, and they're taking a property management fee. Well, all of that gets paid before you as an investor get your split of the cash flow and before you get your capital back. So the deal could lose money. You as the LP could lose money on the deal, and the sponsor has still walked away with something in their pocket, which, I'm not going to say that, people have bad intentions there, because they don't. But at the end of the day, if I was an LP and a deal lost money that I was in, I would be like, I don't feel too good about the fact that I just lost money, but this guy gained. Like, that doesn't seem right to me. So I try to structure deals in such a way that anything that I'm doing is performance based. I do deals where I take fees. I'm not going to say that I never do that, but in that, I always try to tie those fees to performance metrics as well. So when I build out my project schedules, I'll say, hey, my development fee only comes at these specific intervals. It only happens when I've completed this amount of work, and then I'll be allowed to take a tranche of the fee. If I don't get that work done for whatever reason, I don't get the fee, so I'm always trying to incentivize, myself and my team. Not that I need the incentive to perform ethically, but, so that the investor can see like, oh, okay, if this guy doesn't do what he says that he's going to do, or if the deal doesn't work out the way that he's projected, at least they can rest knowing that I don't walk away with a bunch of money in my pocket. And there's risk in every deal. Like, there's risk no matter what. Even putting your money in a bank, that's FDIC insured, there's a risk that, the US could lose global reserve currency status, that we could get bombed by some other country, like, whatever could happen, and you could still lose that money. The risk is very low, but it's still there. And on real estate deals, there is a lot more risk. And, I have not had a deal that, went completely sour where I lost a bunch of investors' money, but it's always a possibility. Like, it's always a possibility. Sure. We always have to be prepared for that. In the event that that were to happen, I want to be able to go to my investors and say, hey, things didn't work out the way I projected they would. I did everything that I could to, get the deal across the finish line. But even though there was, the returns didn't work out the way we thought they would, if you maybe lost a little bit of money, God forbid, still, I got you back as much as I could. I didn't profit on this because, for whatever reason. And I would hope that LPs could look at that attitude and say, okay, the deal didn't work out like we thought, but this guy performed as well as he could have in the circumstances, and hopefully understand that, this was hopefully just a one-off thing, and, still trust me for other deals maybe going forward.
Are you about to start a podcast or producing a podcast and tired of doing the editing yourself? We have produced over 1,000 daily shows, and the production team I've created called Vox Valens Media is now available to produce shows for you as well. We can do as little or much as you need, from finding and communicating with guests, preparing introductions, to editing the audio and video. You will sound better, have a more professional presence, and be able to spend your time doing more valuable tasks in your business. Let me know if you're interested by emailing me directly at whitney@lifebridgecapital.com.
Of course. I like how you're talking about the fees being structured to come at specific times. And on the operator side here, I will say as well, I'm a passive investor as well, and an operator. I would say, hey, it costs a lot to get these deals done, right? I mean, there's a lot of expense. It's a lot to expect just an operator to fund all of that out of pocket, the whole time without being paid anything. But I do like seeing things like that. It's like, well, I expect the operator to be paid, but I like it's at these like milestones, after these things have happened, after we've performed. I feel like that does provide some risk mitigation to the investors. Would you say that that's pretty common across the development industry, or would you say that not so much?
I think it's not common across the development industry. I don't know, really anyone else that's doing it that way. I will say, I think that's made it a lot harder for investors to accept that, which has been surprising to me. I've hit a lot more pushback on structures like that, which is interesting to me. And some I've hit, no pushback and people like it, but some people, get kind of stuck in the kind of standard metric of like, oh, it's going to be, like a 75-25 split with all of these fees. And, seeing something that's, radically different than that is a little tough for some people to understand. I will say the way I'm structuring deals with no fees, it's a lot different in development because, when you're dealing with development or, new construction or whatever, there's no cash flow that's coming in from the property. And so it's like nobody's really getting paid at that point. So it's a lot easier, for me to say like, okay, well, it's not like my investors are getting great cash flow every month and I'm getting nothing. It's like nobody's getting anything every month. Like everybody in the deal, myself included, is going to make money when we sell the deal or, when the deal is built and stabilized. Value add deals, it's a lot different because, you do have recurring cash flow that comes in every month. And I think that those, fee deals are a little more appropriate for the value add space because you have this kind of like recurring thing. It's like, it's not like, I mean, if your multifamily property doesn't make any money for 6 months, clearly something's very wrong. Whereas if you're dealing with a development deal that could take 2 or 3 years, you may not know something is wrong like a year into the deal. The
Right.
sponsor could just, hide everything and say, oh, yeah, everything's going great. Everything's fine. And then suddenly, it's, whatever, you're supposed to exit at month 24. And you as a passive investor find out that, oh my God, there was this huge problem this whole time. And if the sponsor's been taking money the whole time with no, performance metric tied to that, there's just such a risk for fraud there that, it's like the investor doesn't know. And that, so that's why I like to be like, look, I'm going to be completely transparent here. And, if the deal doesn't make money at sale when we're supposed to make our money, well, like I haven't made any money in the meantime, and I'm not going to make my money until you get yours back.
No, that makes a lot of sense. I just appreciate you exposing really the listeners and I to that type of process, or at least thinking, so it's like even investing in a development deal. I don't know. It's just something to at least ask the sponsor about, or have you thought about maybe doing it this way? I think that's helpful. I know we are always trying to align with, our interest with investors as much as possible. Right. And so that's why that's, I think, attractive, in a big way. So at least something to consider as we're doing some developments as well. And so, all right, Andrew, we're going to move to a few final questions, and I'd love to get your opinion on some other things. But, I'd love to know, especially in development, but your thoughts around what's happening right now, or any expectations you have over the next 6 to 12 months, or maybe how that is changing, how you're looking at deals, or how you're moving forward, or buying or not buying, or those things.
Yeah. I mean, we're, I guess, in the definition of a recession right now, although I think some areas are feeling it more than others. I'm in Austin, Texas, and, as a lot of people know, Texas and especially Austin have been seeing some pretty explosive growth over the last few years. The entire Texas triangle from, Dallas, Fort Worth to Houston, and then to San Antonio, Austin. I think that, growth in these markets specifically is going to slow, but I don't think that we're going to see a dramatic reversal in, property values or anything like that, or, population trends. There are so many people moving to Texas, and especially to Austin. There are so many, companies, especially, big tech companies, like Google and Facebook and Tesla and Samsung and all these companies that are moving here with high paying jobs. I don't see that trend reversing, because it's not like in this, recession that, California and New York have suddenly gotten affordable for the majority of Americans. So people are still going to continue to come here. And I think that's going to provide, a boost to the local economy. I think that Texas is going to fare a bit better than some other areas of the country in a recessionary environment, at least in this recessionary environment. That could obviously change in 10 to 15 years, but I see strong growth ahead in the short term and in the long term. I mean, we've seen, 20 to 40% appreciation here in Austin. That's not sustainable. That's not going to continue. Anyone that thinks that it is, and anyone that tries to pitch you a deal saying that their property is going to go up 20% a year, don't do it. It's not going to happen. I think that, if anything, we'll see a very slight dip in prices, or that prices will just stay flat, which I think is more realistic. Maybe we'll see, a couple points going up or a couple points down, but I think it'll remain kind of around the level it's at least until we see some stabilization in inflation and interest rates. And once that happens, I think we'll resume, the upward march. Again, it's not going to be at 20 to 40% a year. It'll probably be at a more standard, 3 to 7%, maybe 10% in some areas per year. And I think that now is a great time to get into development, because development is a multi-year, process that doesn't, necessarily, doesn't necessarily matter around, in terms of recessions. The way I look at it, I think historically from peak to trough in a recession the average is about 18 months. So, if our recession started in January, then we're about 9 months in. We've got about 9 months to go until we hit, the bottom. And this is just, I'm not thinking like, yeah, we're going to hit it in 9 months. I'm just looking at historical patterns. If you're doing a, 18 to 36 month development project, Well, ideally that whole project is funded, when you close the land. Projects that I'm doing, I raise all of the money up front. We've got all of our interest carry, we've got all of our costs accounted for. We don't need any money for the next 24 months. So if you're doing all of that work during a recession, well, it's not like you're trying to like get new tenants in and, all this kind of stuff, new financing in that period of time. You're just like moving along your checklist. And ideally, by the time you're done, then the market is starting to go up again and you can kind of ride that wave up. So that's why I like development right now, because, if you've got a solid deal where you've got the land at a good basis, you've got a good deal with a product type that needs to be going in, something like, housing at a good price, apartments, things like that. I mean, those are things that people are going to continue to need, whether there's a recession or not. And it's certainly something that Central Texas needs. We've got a pretty severe housing crisis. So putting in product to solve that is going to be a solid play.
It's growing like wildfire there. It's massive growth. It's incredible to watch that. Andrew, what's your best source for meeting new investors right now?
I guess referrals. I've got referrals and networking. I'm actually, fairly busy, so I don't network as much as I probably should. But I make good connections just through people that I've worked with before. I've kind of built up a network, and people will, refer me to other people in their network that, are doing something similar, that are looking for deals like mine. The investors that I've worked with know that, I behave ethically. I put my investors first. And so they feel pretty comfortable introducing me to other people in their network. Maybe they've done a deal with me and said, hey, I did this deal with this guy. He did a great job, has a real good attention to detail and, really does his research. The project did very well, so they feel good, kind of put my name out there. I think that's where, a lot of my connections come from at this point.
What are the most important metrics that you track right now? That could be anything personal, professionally, in the business, not. What are a couple of those things for you?
I track, expenses pretty heavily in my deals, and in my personal life, I like to, and in other businesses I own too, I'm always trying to look at, what is, my gross revenue as it would be, which I guess for property would be the price you're selling at, and, what is it going to cost me to get there? And then, what's the profit on that, and how does that get split between investors and partners? I pay pretty close attention to investor return metrics also. I think it's very important to give investors an appropriate level of reward for the level of risk they're taking on. So I try to be very, very cognizant of that and make sure that, I'm putting a project out there that has returns that are competitive with the market and that are appropriate for that specific deal. Not every investor is going to understand the nuances there, but that's always what I'm looking for. Is I want to make sure that, investors are getting a good return for what they're doing. I'm not trying to like lowball investors on their return.
Well, what about some daily habits that you are disciplined about that have produced the highest return for you?
I try to maintain, a pretty regular sleep schedule, and just basic schedule throughout life. I try to go to, bed around the same time, wake up around the same time, have a morning routine, which is, I'm not getting up at 4 a.m. and like, reading, self-help books or anything like that. But, I try to, get up at the same time, exercise, make my wife coffee, make my breakfast, check my email. And, that kind of helps keep me centered, and focused. And I find it just helps my brain and my body, turn on and turn off like at the right time. I'm less tired. It's, I try to like, for instance, get up at 6 o'clock. I try to start my day by 8. And in having a routine, my brain and body kind of knows like, oh, it's 8 o'clock. It's time to turn on. It's time to go to work. And it's ready for that. I'm not waking up at a different time. And I'm still groggy and trying to get started. It, just kind of helps there. Same thing. I go to the gym, I'll go to the gym kind of on regular days and my body knows like, oh, like it's Wednesday. It's time to do this work. Like, let's go. And
yeah. Important thing you said there is that you do in the mornings was make your wife coffee.
Oh yeah, I know. That's a big thing. And she gets on me when I don't do that. So, she's like, I noticed when you don't make me coffee.
How do you like to give back?
I like to give back through helping people. I'm a big believer kind of in the adage of, teach a man to fish and you feed him for his life. So I always try to help people more than like just give them money. I don't feel that just like giving people money really solves problems. I mean, any lottery winner can like kind of attest to that. Like just having a bunch of money doesn't solve your problems if you don't know how to, manage your life. So, if I'll see, people asking for help or, typically what I'll say is like, well, I'm not going to give you money, but, I own this business. And if you want a job, why don't you come by and, I'll see if, we can help you out there and get you in a position where you can help yourself. I think that's really important. That's always what I've wanted from people in life. I don't really just want money. I want, opportunity so that I can do it for myself. So that's how I try to give back to people, whether it's, advice, whether it's a job. That's my preferred method of giving back.
Yeah, no, I like that. Teach a man to fish, right? Not only do you help feed he feed his whole household and hopefully for generations, right?
Exactly.
So Andrew, grateful to have had this time with you, get to know you and just dive into development and different aspects of development. I think you've helped active and passive investors in many ways to help think through, hey, that next development that they're looking at investing in and many questions and things that they need to know to ask about. So grateful for that. Tell them again how they can get in touch with you and learn more about you.
Yeah, people can learn more about me by going to my website, which is www.irongallinvestments.com. That's IRONGALL investments.com. You can get in touch with me directly by emailing me at andrew@irongallinvestments.com. And you can also look me up on LinkedIn and Facebook if you'd like to connect that way. If anyone out there is, looking at development deals, want some advice, want some help evaluating a deal or anything, feel free to get in touch with me. I'd be happy to, help walk you through some certain things that you should look for, see if I can find some red flags, hopefully we can, make a connection there. And, I'm always looking to network with, investors, capital partners, deal partners. I'm always down to have a conversation with somebody and see if there's a way to, to work together or, to just become friends. I have a lot of people that I don't work with, but I'm good friends with, and, always happy to make a friend.
Thank you for being with us again today. I hope that you have learned a lot from the show. Don't forget to like and subscribe. I hope you're telling your friends about the Real Estate Syndication Show and how they can also build wealth in real estate. You can also go to lifebridgecapital.com and start investing today.